future. We're talking real money.
Like it or not, Talking Real Money continues with another exciting edition of our little podcast. Hello, everyone. I am Don McDonald over there. Well, not physically over there, but electronically right over there. Looking right at me is Tom Cock.
Hello.
I don't know how this works when he's a continent away. A continent that I will soon be driving across.
I got great news for you. I didn't share this with you. The paving project is on for the last week of January. They are coming out and laying down the asphalt, baby.
It'll probably rain. Miserable, wet, cold rain the whole time.
They said they have to wait until it's not pouring.
Then they need to wait till June.
Yeah, well, it's earlier now in Seattle. Comes in middle of May. So
okay, all right. And for those of you who know, Tom is. I have my Airstream that's getting fixed up. It's almost done. And Tom said, well, if you come out to Washington, you stay a month, I'll pave a driveway for you next to the house. Well, I'm thinking that'll save me thousands of bucks in RV park fees.
There you go.
So he literally is paving a spot next to his house.
And funnier yet is my 15-year-old daughter who said, wait, you're making them stay outside? Can't they come in the house?
Hey, we've got a really nice trailer.
I said, that's up to them. Sweetie. They can stay where they like. So she thought that was funny.
And we're bringing the dogs. So Buddy will have somebody, not Buddy, Tucker will have somebody to play with.
Tucker will be so happy.
Anyway, here we are getting together to talk about money. And once again, the part of money we're going to talk about is building your investment portfolio and how you should build your investment portfolio. How diversified should you be? There seems to be, we believe in diversification, but apparently there is some disagreement among people in the financial industry as to what diversification really is. How diversified is diversified?
Yeah, this is a question that comes up. I mean, I think if you hear from Jim Cramer at CNBC, and I hope you don't hear from him too much, I think he says between 10 and 20 stocks is diversification.
Oh, my goodness, yes. That's less diversification than the Dow Jones Industrial Average.
And he wouldn't mind if it's the 10 or 20 stocks he recommends, by the way. And then we'll talk about Professor Horst Meyer here in a couple of minutes. But let's first talk about what diversification is really there for, right? It should be there for reduction of risk. This is where part of the misunderstanding. People think, well, I'm going to diversify, I'm going to make more. Well, I wouldn't count on that. I would count on less volatility. And then that other part is when you own single stocks, they can go out of business, right? If you own thousands of companies and that one goes out of business, you don't care. But if it's one of the 10 or 20 you own, it could be really, really bad. So let's talk about what all that means, right? And this comes from a Wall Street Journal article. They go into the pros and cons of diversification. Pros, according to the writer, lower risk and volatility, more consistent returns, which again makes sense because you're holding thousands of companies. And the cons, they say, are potentially lower returns, which is true. If you bought the right stocks for the right period of time, you made more. But interestingly enough, from our friend Paul Lupescu at Dimensional, just mentioned these numbers a couple of days ago, 22 and 23, right? The last 2 years of returns. If you'd owned the NASDAQ, which had a huge run up in 23, you actually ended up after 2 years down 2%. If you owned a globally diversified portfolio of somewhere around 12,000 stocks, that's 3,000 in the U.S., 9,000 outside the U.S., you made 6%. Now, no promise that's the way it looks in the future, but again, you're owning a wider number of enterprises, correct? So
correct.
Cons,
yes.
You just have more businesses that you're investing in. The cons, which is interesting, potentially lower returns, I totally agree. It could be. That would be a random event. Extra maintenance. If you invest in individual stocks, they say there's a cost in terms of the time it will take to manage your portfolio, monitor and track each company you're invested in, and ensure it stays well diversified over time. Now, there are such things as mutual funds and exchange traded funds. They'll do all that for you. I have no idea what they mean with that.
Do it all for you without much in the way of money being paid.
Well, they do. That's another con they offer, and the cons of diversification is higher costs.
No,
which is well, that would be true if you had 10 or 12 individual stocks. versus paying an exchange traded fund 0.11 or 0.2, whatever. I mean, yeah, it'd be, but you're getting a lot for that 0.11 or 0.2. I think that's a silly
No, because you've got to rebalance your portfolio.
Good
and
point.
You're going to incur commissions to do that. There are trading costs. There are taxable events along the way. So there are costs. They're being a little, well, okay, continue.
Yeah, well, I think that's a fair point, Don. Very, very fair. So then we get into how much diversification is, as you started diversification. Here's a direct quote. If you opt to buy individual stocks, achieving peak diversification isn't as difficult as you may think. This comes again from the article. A 2021 study co-authored by Professor Horst Meyer found that adding more stocks to an investment portfolio made it less volatile until it included about 20 stocks. After that, the benefit was negligible. In other words, if you have the right 20 stocks, I guess if you get one from each particular sector or something, or one from each country, that somehow is enough to own. I think that's an outrageous statement. I have not seen the study, but that makes no sense to me.
I'd like to see the study, because I'd be willing to bet that the study didn't compare. It probably got to 20 or 30 or 40 stocks and said, okay, there isn't much difference between 10 and 40 or 10 and 50. But I would be willing to bet that there's a very big difference between 10 and 13,000.
Yeah. I mean, it just has to be. Right.
I think it has to be. Yeah.
I would say it does. And then they go into some of the other parts of diversification that many of you do not use. Smaller companies, right? Value companies. Most people, it's still 80% of the invested money in the United States is in large companies that are more growth oriented. It is. I don't know. Maybe it always will be. We're going to be begging you for as long as we're here on the air to own some small, some value, and that other part that actually had a decent year last year, international stocks, right?
What?
Investing in
international
other
stocks finally did well?
Well, not as well as the United States, but well, right?
But better than they've done.
And by the way, that's another piece that Apollo mentioned in his talk the other day, which is fabulous. This is the part people forget. If you go back 50 years, there are periods of decades where international way outperformed. The 70s, the 80s, then the 90s, it was the U.S., right? The aughts was international. And then the 10 through 19 was U.S. So it may seem like, well, I'm just going to put it all in the U.S. because it's better. Not if you look at the long haul. That has not been indeed the case. So you want to have those in diversification as well. But overall, I would say the following. If you really own 10 to 20 stocks, as Professor Horst Meyer suggests, that has to be called stock picking, doesn't it?
Of course it is, because you have to pick the stocks.
I mean, so
unless you just randomly draw stocks from a hat, you use the monkeys with the dart technique.
Yeah, and so anything really less than owning at the aforementioned 3,000 in the U.S., 9,000 outside the U.S. or so, it's individual picking. You're making a choice that Boeing will do better than I don't know, Tesla.
It doesn't work. I was going to say Airbus. No,
Airbus
that doesn't work.
Doesn't work. Number two, as we mentioned, in a general sense, you can own all of them at a very low cost. You can own the entire world for 0.2%. I mean, that is a ridiculous deal.
I would hazard again a guess that you could own even a portfolio of a few hundred stocks through a mutual fund for less than you as an individual could own and rebalance 10 stocks. Because the expenses for individual investors to do that, they're still going to be, dollars a year. And when you get into index type funds, the expenses can be fractions of a % a year.
I know. And going down, which is something we'll discuss in a later date. And here's a couple of ideas / examples. You've heard us mention them before, but I'll mention them again. Just had a discussion with a listener recently about whether or not it makes sense to pay 0.23 for a fund like AVGE, which is the Avantis Global Equity Fund. I think it does. Mm-hmm. Or Dimensional now is a very fine global equity fund, DFAW, also a global equity fund, all stocks, low cost, wide diversification. To me, that's diversification, owning all of those rather than trying to pick the 10 or 20, rather than sort of moving in and out. That's another thing we see people doing. hey, I don't want to be in that anymore because it hasn't worked for the last couple of months. That's market timing. So stock picking, market timing, none of those things have any track record of working, Don. I'd rather be widely diversified, low cost, and tax efficient, and that's it.
By the way, the DFAW, the Dimensional World Equity ETF, has an expense ratio of 0.25, ladies and gentlemen.
Which we consider
That's
inexpensive.
Pretty low. And inside that portfolio, because it includes the dimensional core equity, the international core, the emerging markets, the global real estate, because it includes all of those funds within the fund, you have multiple funds. And this is where, with all of this global portfolio of stocks in these funds, you get to that 9, 10, 11, 12, 13,000 stock portfolio that we're referring to, as opposed to 10
total, not 10,000, 10 stocks.
10 stocks.
Yeah,
10.
I think
Which
it's poor
sounds
advice.
better from a reduction. I mean, just logically, from a reduction of volatility standpoint, which sounds better to you?
Your intuition should tell you that more should equal less volatility and less overall risk. The more you've owned of something, the risk has to be less because something bad could happen to 1, 2, 3, 4 of those stocks. Could happen to one country. I mean, that's
the other thing is, if you have a 10 stock portfolio,
right.
What do you have? One small cap stock, maybe two. You have one large cap, one large cap value. You can't cover all the asset class bases either in a portfolio like that. You just don't have enough room to do it. I have a REIT. I have one emerging market stock. I have, two small caps, value. You just can't cover all the bases. Whereas with a fund, you can pretty much cover all the bases for not much money.
And for the previously mentioned reason, you're not going to have much in international stocks. And we think we can clearly show you that, that is a place to be. Another stat I learned this week, I knew Japan had run up massively in the 80s. And I had no idea that in 1990, the value of their stock market was greater than the U.S. market. So, and think of all the people in Japan who has all their money in Japan, and basically the Nikkei has made nothing. I think it's still underwater in those last 34 years.
From the high? Yeah.
From the high, I think it is.
From the high.
So, yeah, I mean, it's insanity. So, yeah, that's not diversification. This is really pretty poor advice, I think. We can safely say that.
No, it's terrible advice, in my opinion. Hey, we love to get questions from you. You can send them in to us at talkingrealmoney.com. You can record them right there with your microphone on your computer or your phone, or you can type them, and then it makes Tom happy because he gets to read them like this.
How do you know to have somebody reading them to me? Anyway,
because I actually hear your voice speaking them, as does the rest of our audience.
It's special.
Unless it's a great Tom impersonator, and I don't think there's a lot of demand for that.
Nobody wants that job. We're going to the Midwest for these today.
Oh, that's
been
nice.
Chilly, I know, because my brother's there and regularly reports to me that when I complain about the 20 degrees here, he goes, "Are you kidding me?" Anyway.
Yeah, we got 20 below zero in the shade.
I think they did have something like that recently. This is from Scott in Farmington Hills, Michigan. It says, I'm 59 years old and not close to retirement, which was a bit of a head scratcher, but okay. I have $45,000 in a self-directed HSBA through Schwab. Now, I know what an HSA is.
What's HSBA?
I was hoping you would know that. But while you're trying to find that out.
I don't know what that is.
Currently in Schwab's SBA. It's currently in Schwab's Value Advantage Money Market Fund, SV.
Oh, it's just, okay, it's an HSA.
That's what I thought.
Okay.
He's got it all.
They just call it an HSBA.
He's got it all in the Schwab Money Market Fund, SWVXX. Mm-hmm. Don't intend on using the funds until he's in retirement. He's thinking of moving them into a 2-fund strategy, 90% in a 2035 target date fund and 10% in SCV. Is this a good strategy for an HSA, or do you have other ideas? I can tolerate risk. I know my opinion on this, but what's yours?
Wow.
So the 2035 is going to be a 60-40, basically.
Yeah.
Something like that. And then you got another 10% in small cap.
Right. And again, as long as this is money that you're certainly not going to use.
That's what so don't you think you'd want to have some of that in like the money market just in case something comes along?
I would.
Yeah.
I would, just in case you've got some surprise medical bill that exceeds your ability to pay it from other assets, or you want to pay it from tax advantaged assets.
Mm-hmm.
I would probably just go all with the target date.
Then you're going to have a certain amount in fixed income that
I'm going to have some in fixed income with less volatility.
Yeah.
But I don't think it makes a massive difference.
No,
I think we're going to be quibbling over. This sounds like someone who has the means by which to cover things from other assets. It sounds like they've thought it out. And if you truly are not going to need it until retirement, you could go even more aggressive than that.
What would be more? Oh, you mean just take a target date fund of 2040 or 20?
Right, go out a little longer.
Longer. Yeah,
just
okay.
to make
So then
you
still have a little bit in bonds.
Yeah,
I think that's reasonable. I think our plan makes us keep $1,000 in cash. Basically, you can't invest that.
I don't know because I have a low deductible plan, not a high deductible plan.
I'm in the very high deductible plan.
No.
And I'm saving a lot into my HSA. So great question. Thank you, Scott. And now we go to Dubuque, Iowa. On the map
where it's
recently.
Also cold.
Yeah, which on the map recently, not just for the cold, but for the recent caucuses. And Jim writes us, considering this fund, Boston Partners Large Cap Value Equity Fund Class E, and I don't know if that's Class E or Class E. Expense ratio expense ratio in my 401k is 0.32. 401k currently invested in 36% FXAIX, that's Fidelity's S&P 500, at a 0.15 expense ratio. Would it be a wise decision to split my U.S. large cap in these two funds between the S&P and the value, adding the Boston Partners Large Cap Value Fund?
Well, I mean, the advantage to it is it gives you a value tilt to the portfolio. Problem is, for an actively managed fund, it is inexpensive. That's probably because it is not. It's not a fund that's sold to the general public.
This is only private for.
It's got to be in plans. Yeah. Mm-hmm. So I got to tell you, it's done well. It has beaten the Russell 1000, but it has done so with a higher degree of volatility, which makes perfect sense. That making more money generally requires taking more risk. However, that risk manifests itself. In this case, it manifests itself in greater volatility, which makes perfect sense because when you get to really diversified portfolios, that's where the difference lies. So it's made more, but it's been more bouncy.
And it has a much higher expense ratio.
And
so here's what I would do.
And that was what I was getting to. the expense ratio is really over and above just having a value index.
Yeah.
Maybe enough to knock out whatever advantage having value gives you in that portfolio. So maybe the better way is to stick with the cheaper index fund in this account, in this plan, and then using other accounts elsewhere, IRAs or just taxable accounts, to use ETFs to get your small cap value tilt.
Yeah. Okay. Or here's the alternative I had, because he was saying split it. How about 2/3 in the FXAIX and 1/3 in the Boston Partners Large Cap Value Fund? Unless, as Don just said, you can get that same exposure in a Roth or a taxable account outside of the plan.
If you're saving outside of that plan, which most good savers are doing, then that gives you the opportunity to pick up. Because remember, each section of your portfolio, each account in your portfolio, each type of plan should still be considered part of your overall portfolio diversification. It's all one big portfolio for you. So you can have all of your large growth mainly in the plan at work, and then you can pick up your small and your values and your internationals in other investment portfolios outside of that. That's all I'm saying.
Yeah. So, and again, this always gets back to this point that people have trouble with. That is, you need to look at all of your money as one portfolio rather than having 6 portfolios.
Yes,
Very important concept.
Exactly. Holistic investing.
Yeah, indeed.
It does sound very trendy, though, doesn't it?
We're going
to holistically invest.
I know it's going to.
Everyone breathe in.
They're going to call us lefties again if we say that. So
breathe
please
out
don't.
through your mouth.
Don't say it. Because
now envision a portfolio in perfect balance. What is that? Just spring a leak?
That was the mystical, breeze blowing
he's
through.
Just leaking. He's just like a balloon.
Well, if they pop me, I'm sure that'll happen. Yes,
yeah, it's probably true. Thank you for those questions, Tom. You did a lovely job reading them today.
Thank you so much.
It was
finally doing my job.
Stirring performance. And speaking of stirring performances, if you want to help him with future stirring performances, send questions in at talkingrealmoney.com. Better yet, though, if you want to just hang out with Tom for a little while or some of our other fiduciary advisors at Apella Wealth, we'll do that. We'll talk to you. We'll help you for nothing. And unlike many who say the same thing, and there are many, we'll give you a free consultation and portfolio review. No, you won't. You'll give me a free talking to and sales pitch. That's what you'll do. We won't do that. Just go to talkingrealmoney.com and click on Meet an Advisor, because we really, truly do want to help everybody. And that's why we hang out here all the time. Doing what, Tom?
Talking real money.
Ooh.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Apella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.